Here's two charts of the silver, weekly chart of silver. The top one is this year, and we had a big run up. We had a pause in October. We had another little hiccup here just about a month and a half ago. And then we had the blow off phase all the way up to 120. And then silver has pulled back. And so that's where we are more or less right now. Look at what happened in 2011. Look at the charts, like comparing, like they unfold, they move very, very similar. We had the sharp pullback in 2011. This is exactly what you just walked through, David. It's like the market traded sideways, it drifted its way up, but then it eventually broke down. I think there's a lot to look at here. If we look at the individual stock like Microsoft, it put in this huge double top formation. Both times were big moves on news. Both times they also got sold off into. It then eventually put in kind of a topping pattern. It broke down, and since then it's formed a bearish pattern. And of course, it's still selling off, and it still does not look very healthy. And so Microsoft, that's a big red sign, a big red flag for the markets. But when we step back and look at the bigger picture, as you were mentioning the Magnificent Seven, we are in a very unique situation here. So we have this topping formation right through here with the Magnificent Seven. That this is a very critical support zone on the chart. And if this breaks down, which it actually broke down yesterday, which is Thursday, that is not a good sign. It is actually pointing to a fairly significant pullback. I think we could see the Magnificent Seven pull back roughly 20%, which if the Mag 7 falls that much, it will pull the NASDAQ down about 11%, 9 to 11%, depending on which stock. So just this chart alone, the fact that the Magnificent Seven have put in what looks to be a topping formation, are breaking down, that there is telling us that could be like a 9 to 11% move in the stock market. And then throw in all the other stocks that will also get sold off. They could easily send the stock market tumbling. So this is a huge red flag that we're seeing this breakdown. And there's a lot of things that are screaming as the market broke down yesterday as that was happening. In fact, we had panic selling on my short-term indicator. When there is panic selling, that is not a good sign when there's too much of it. So if you have too many things line up, too many good things is a bad thing. So panic selling on this green indicator. We also saw the VIX spike up, David. It had a pretty good pop up into a resistance zone, telling us there was kind of mass fear. We saw the put call ratio close above 1, telling us that most people are buying put options. They're all betting on falling pricing. Now, this is a bit of a short-term contrarian indicator. This is a very weird chart to look at. I like to look at this. It's a little thin blue line in the background, but it's moving up. People are naturally getting more and more bearish, which is good. But the short-term spike in the put call ratio and the panic selling in the VIX yesterday is a short-term indicator that we should see a bounce in equities today, but it's just going to be a little bear market bounce. And when we look at like the S&P 500 here, we have a little lower wick this morning on the daily chart. It's bounced back up, but overall, I think this is going to eventually get sold off into. And the S&P 500 has been holding up fairly well. When we look at it, we on a 30-minute chart and zoom back about a month and change, we keep seeing the stock market, the S&P 500, dip into these lime green areas. Now, these are oversold. This is typically when the market gets bought back up, institutions step back in, or individuals buy the dips. And we actually had that just early this morning on Friday as we talked about that. And now the market is bouncing and moving up. And surprisingly, we actually have our FOMO indicator, which usually puts in a short-term top for the markets, kicking in today. And so what's really interesting is the S&P 500 is still holding up above this major support line through here. But when we look over at the NASDAQ, which to me is the big heavyweight and also has the Magnificent Seven in it, it has really broken down through this high, through these series of highs. It broke all the way down and then it bounced up. And today, when we're looking, we're seeing the stock market have a bit of a bounce, but the NASDAQ is just refusing to get traction. And when you have a downtrend, red bars, and our FOMO indicator spiking, usually that means whoever's going to buy today is buying, and next week we'll probably see sellers step back in. So the stock market looks very, very sick, from the Magnificent Seven to the NASDAQ, and people are nervous. They don't know where to go, and they're not believing in gold either, or silver right now. And that's why we're seeing money flow to the kind of the old defensive sectors that everybody used to go to before silver took on all the excitement and the Magnificent Seven.
The spotlight now turns to the so-called Magnificent Seven, mega-cap titans that have powered much of the rally. Collectively, they appear to be breaking beneath a crucial support zone. If that breakdown holds, the implications are substantial. A 20% retreat in this concentrated group could drag the NASDAQ composite sharply lower and pressure the broader S&P 500. Given their outsized weight in index performance, their decline would not be symbolic. It would be structural. Leadership deterioration often precedes wider market weakness, and this moment may represent a turning point rather than a temporary pause.
So yeah, the markets have a lot of mixed signals, even in the precious metals space. So for example, if we take a look at GDX, for example, it has mixed signals in terms of the long-term trend. If you look at the long-term moving average, they're still sloping up. So the tide is still rising, but short-term and volume-wise on the daily chart, there's a lot of damage done here. And this is actually pointing to potentially another big leg down. We could see miners fall about 15% very quickly here, just using a simple kind of Fibonacci retracement or extension level. We could see like GDX fall down to about 85 very quickly. And this is what gold is showing. This is what silver has a much more bearish outlook than this. It hasn't bounced and made higher lows and higher highs recently. So what we've done, I mean, we've moved out of most of the equities markets. We're still long the S&P 500. We closed out our NASDAQ play a little while ago, and we actually sold our gold position right up into this area. We also sold and closed out our half of our silver position right up at 113, way up here. And just recently this week, I closed out the rest of my physical metal position. So I'm completely out of metal. We've got huge moves since 2019 and the 2020 COVID crash. That's when we accumulated. And now I have closed out my metal plays. Now, if precious metals are to start another big leg and go parabolic and have another huge surge, I will simply be playing the precious metal space with ETFs because I believe it'll be a very fast, explosive move. And it's just easy to get in and out with a click of a button with ETFs. But when it comes to physical metals, this is where I stand apart from, I think, most other people in the space, which is I believe price usually gets factored in, gets woven in before the news hits. Buy the rumor, sell the news. People are expecting big and bad things to happen in the economy. We're seeing all of that get priced into silver. We're seeing all of it get priced into gold. When you look at the gold chart, this is what we've seen in the past. And then suddenly when the bubble bursts, everything collapses and gets sold off. And so that's kind of where I'm at this point is I'm locking in, protecting capital. If precious metals build a launch pad, a bullish pattern here and want to go higher over the next few weeks and potentially scream, gold 6,000 and silver, 150 or something, I'll be taking advantage of that through an ETF. But I believe most of the damage, I believe most of the upside is done. I think there's a lot of downside potential going forward, and the silver chart clearly shows this. So if we look at the silver chart, we can look at this sharp drop to the downside. Depending on where we want to pull off one of these lows, it is pointing to a significant drop in price. It's looking for about $41 silver. And if we take the more drastic standout low over here, it is pointing to roughly $28 silver, which is what, the market is not expecting. Of course, everybody a few weeks ago thought silver was going to 200 and 400. And then silver, the market always has a way of catching people off guard. So this is what the chart of silver is pointing to, 40 or 28. And obviously that will wreak havoc with margin calls. That'll be probably, one of the quickest and sharpest pullbacks in silver in a long time. So that's the downside. That's what I don't want to hold on to metals for. If metals build a base and start to go higher, I want to take part of it. But I am not going to hold on to a sinking ship that's made out of metal, right? So I'd rather step aside and get back later or, be able to pick it up at these rock bottom pricing when the next wave down kicks in. Because silver and precious metals have run up on emotions and a lot of excitement. And this is only leg one. I think there's two waves that happen when it unwinds. And we've only seen the first leg down.
As prices slid, fear surfaced rapidly. The CBOE Volatility Index spiked, signaling a surge in anxiety. Simultaneously, the put-call ratio jumped above 1, revealing traders aggressively hedging against further losses. Panic indicators flash, suggesting emotional extremes. Yet markets rarely move in straight lines. Short-term rebounds, often labeled bear market bounces, can occur even within broader downtrends. Interestingly, fear and FOMO can appear side by side. Investors rush in during rebounds only to face renewed selling pressure. These emotional swings reflect a market grappling with uncertainty, where sentiment shifts quickly, but underlying structural weakness remains unresolved.
Yeah, I find when we get into this particular type of environment where precious metals are in favor, they're the rising star, I find gold is the ultimate barometer, and silver. I like to play the physical. It's also outside of the stock market. So if the stock market does sell off and start to crash, sometimes gold and silver will hold up or move higher, but the miners might actually pull back because they're a stock stuck in the stock market. So I'm not really that big into miners. I haven't been for a very, very long time. I believe after we have a financial reset and gold and silver have corrected and miners get beat up really bad, that's when I'm going to be looking to get back into miners, and more specifically, probably like individual miners, because I believe we're going to go into a multi-year run. I think this move up that we're having right now in miners and in metals is a lot like what we saw back in 2008. You and I have touched on this many times.
Yeah.
I believe it is something similar to this. I think if we were to just zoom in, we saw gold trade sideways for a few years, and then gold took off just before we went into the financial crisis, and gold sold off. Miners got absolutely slaughtered, all of that stuff. So I believe we are right here. I believe we're in this topping phase, and what's going to happen, we're going to see gold, silver, miners sell off. Eventually, this is when I start to get excited. This is when I want to buy golden rockets, because we go into a multi-year big move, and this is when I'm going to be excited. And I've talked about this for many years, saying I'm not interested in miners until this scenario unfolds. Until then, I like physical metals myself because I just like the way they move, and it's just part of how I manage my portfolio.
Gold and silver, long viewed as safe havens, are sending mixed signals. Mining stocks such as VanEck Gold Miners ETF show long-term uptrends but short-term technical damage. Meanwhile, the silver chart suggests potential downside targets near 41 or even 28 if momentum accelerates. Emotional rallies often overshoot fundamentals, and history reminds us how quickly parabolic moves can unwind. The explosive surge in 2011 offers a precedent. When optimism peaks, corrections can be swift and unforgiving. In such environments, capital preservation becomes as important as capital growth.
Yeah, I think you bring up some really good points. So a good example is, like, another way to look at that too is here's two charts of the silver, weekly chart of silver. The top one is this year, and we had a big run up. We had a pause in October. We had another little hiccup here just about a month and a half ago, and then we had the blow off phase all the way up to 120. And then silver has pulled back. And so that's where we are more or less right now. Look at what happened in 2011. Look at the charts, like comparing, like they unfold, they move very, very similar. We had the sharp pullback in 2011. This is exactly what you just walked through, David. It's like the market traded sideways, it drifted its way up, but then it eventually broke down, and it took a decade to come back, right? It took a very long time. And most investors aren't expecting this, which is why there's a good reason it could happen. And I think that's what we need to be aware of. And this is exactly what unfolded in, like, the same drop, almost 37. Well, when I drew this chart, it was 37 and 33%. This pullback we've had now is a little bigger, as you said, about 40%. But we have a very similar chart pattern. This is typical psychology. We have a lot of people talking, saying everything's being manipulated, all of this stuff. But just go to like GME, go to all these GameStop, all of these other emotional driven moves. They all do the same thing. Stock pricing is based on emotions. It's the staircase up, it's the elevator down, it's super emotional, very volatile. They kind of repeat themselves over and over again. It doesn't matter if it's a stock or a commodity. And, you know, an interesting chart here, David, is if we look at the silver chart, and again, this is kind of one area where, you know, I go against the grain for this, but let's take a look at the chart of silver, and let's just go way back in time. And if we look at the chart price action here, you and I have gone over this several times, is, this chart shows silver. You don't have to be a rocket science to figure out usually what happens when something goes parabolic and straight up. I mean, it went all the way up to here, and now it's already starting to come back down. Now, the nice thing about this is I use a linear chart. That's why you see these parabolic moves. I actually just did a presentation teaching the difference between linear and logarithmic and the power of using this style of chart. And so when you use this style of chart, you see these parabolic spikes, and seeing a parabolic spike is an emotional surge. And it tells you to be aware, to protect your capital. And everybody, a lot of people in the precious metal space, they all go to the log chart and they look at it like this, which looks totally different. And they have the exact opposite. They are all talking about, well, there's a giant cup and handle pattern here. We should see $200 to $400 silver, all of that stuff. This chart is saying the bull market, the next big cup handle has just started and it's going to 400. And maybe it has, but keep in mind, this is a 45-year cycle. I won't even know my name by the time this thing plays out. And so this chart and pattern is saying buy, buy, buy. And then when you look at a linear chart, it's saying sell, sell, sell. And so you have to buy into your time frame. You got to figure out what strategy fits you, right? And even if this is, and it most likely is the start of something way bigger for gold, or for silver, thing is, this could pull back and trade sideways from here, and just over to here is 5 years, right? And then it could start that next big move up, and that's what you just talked about. 2011, we saw things trade sideways for a while. It faded down. It took a few years to recover. So you have to really, focus, not get sucked into big, lofty pricing that's based on chart patterns that are way outside your time frame. And so that's where I am at silver. I think, when you look at these big pictures, I totally agree. I think gold will be 10, 15, 20,000 in 10, 20, 30 years. I think silver will be dramatically higher, but there's going to be decades in there that are lost that I think anybody who's been in the precious metal space for a long time knows how painful it is to hold gold miners after they peaked in 2011, right? It's like you hold on to them for a decade and you just wish you did something else, and then you can get back in when they turn up, and something like that could happen again. So I think it's really important for people to step back and, maybe not drink all the Kool-Aid from the precious metals space, which is like, crazy, ludicrous pricing. This time is different. And even if it is different, you have to have a strategy to get back in, which is kind of what I've been focusing on, trimming out of physical metals, getting ready for faster plays in ETFs, because we could see another big parabolic spike and I don't want to miss it. But I'm not going to expect that this time is different than any other time, because every other time it plays out the same. It's not the end of the world. Prices fall back down, all of that stuff. So I'd rather go with what normally happens and kind of manage positions from there.
Market history rarely repeats exactly, but it often rhymes. The surge in metals ahead of the 2008 crisis, followed by a brutal unwind, offers a striking parallel. After peaking in 2011, precious metals endured years of stagnation before recovering. These cycles reveal a pattern. Emotional buying drives prices vertically, then gravity returns. Comparing today's structure to that earlier era suggests we may be in a topping phase rather than the beginning of a sustained supercycle. Long-term optimism for metals can coexist with short-term caution. Timing, not conviction alone, often determines investment success.
I'm going to show you one more chart before I pass it back to you now, Chris. I'm going to show silver with gold and copper and palladium and platinum. I've showed this on my show a couple times in the last week, and I want to just get your opinion. The reason I'm showing this is because all these metals moved concurrently at the same time. So we have, let's take a look at what happened here. So I had you on the show January 30th or late January. Or not January 30th, but
it was the 26th, 28th or something like that.
25th to 26th. Warned us about this coming drop, and then all of these metals, all of these hard commodities dropped exactly on the same day, rebounded exactly on the same day. The magnitude of the drop was, it varied per asset class, but the direction was all the same. The timing was all exactly the same. You're looking at this chart as a trader. What's your first conclusion here?
Yeah, I teach this all the time, is a stock, it doesn't matter what stock, or sector you have or what index you have or what global index you have, pretty much when the stock market crashes, almost all stocks go down. A stock, I don't care what it is the same trade. It's an equity, and there's naturally ebbs and flows that they all move together. Precious metals are the exact same thing. Doesn't matter if you have platinum, palladium, copper, miners, whatever it is, right? They are all the same trade. It's the same sector as you just said, David. Just some have bigger magnitude swings than the other, percentage-wise, but they pretty much all move together. And that's why, like, so many people are like, "Oh, I'm diversified. I got a whole bunch of different metals and stuff. I'm good." I'm like, "No, you just hold a whole bunch of rocket ships that they're all going to crash at the same time." So the whole key and my whole strategy philosophy is like, own an asset class when it's going up. Precious metals, I don't care, mix them up, play them all. But when it starts to show signs of weakness, you need to lock in profits and lock in the gains. And it's the same with the stock market. There's a time to hold stocks and a time to just step away. And it's not about having positions on all the time. It's about protecting what you have and understanding that it's not about, always trying to pull money out of the market. If you can avoid big losses, you can make a lot more money in the long run than riding things out.
In volatile periods, flexibility becomes a competitive advantage. Rather than holding assets through deep drawdowns, some investors are rotating toward defensive positioning or liquid instruments like ETFs, ready to re-enter if a new uptrend forms. Commodities such as gold, silver, copper, platinum, and palladium often move together during liquidity shifts, underscoring the illusion of diversification within one sector. The core principle is simple. Participate when momentum is rising, step aside when risk intensifies. Markets reward discipline over emotion. In uncertain cycles, protecting gains today may provide the ammunition needed to capitalize on tomorrow's opportunity.